In Investing 101 today, John Bever, the president of Phase 3 Advisory Services, is here to talk politics and money and dig a little deeper into these midterms. John, great to have you here. And how do midterms affect the stock market?
Midterm elections do have an effect. So there have been 21 midterm elections since 1935. This will be number 22. And since then, the president's party, on average, has lost 30 congressional seats. Only twice has the president's party gained seats in both chambers. So since the stock market usually doesn't like uncertainty and change, we would expect midterms to be bad years. However, on average, stocks have gained in the midterm years. Now, research by Capital Group shows that the gains tend to come at the end of the year. In any given year, stocks tend to rise throughout the year with a late summer correction. But in midterm years, on average, stocks trade sideways until the typical October lows and then take off from there. Now, the averages don't show the whole picture because in 7 of those midterm cycles, stocks have actually lost ground. So 7 lost, 14 gained over the last 21 times. That's 25% of the time the stock market is down. That fits about the normal average for the stock market anyways. It's just how the market gets there during the year. So what's interesting is that the year following the midterms tends to be a very good year. And this would be the 12 months following the actual election. Since 1950, on average, stocks have increased 15.1% per year in that year following versus 6.8% for those other years. So even when the House flips control, this pattern does hold true.
Is that because the stock market does not like uncertainty?
That's exactly right. And as you get closer to the election, there's a little less uncertainty.
What should investors consider this year?
Well, it's interesting because the larger effect on stock prices actually seems to be Fed policy and inflation and not this midterm cycle, as we've just talked about. And there is a change in Fed policy this year. Monetary policy may have an outsized effect on this midterm cycle. We're entering a longer rate hike cycle. The Fed is now signaling a quicker pace to removing its liquidity. And since the financial crisis, the stock market has actually sold off on tightening. So stocks do not appear to be priced for this right now, but they're adjusting. So as a result, we would recommend moving from growth to value. So what does that mean? It means getting out of new tech and perhaps going into pharmaceuticals or old tech or financial, something along those lines. So the midterm cycle should not drive your investment decisions or your long-term investments. It can inform your short-term trading. Fed policy is a much better guide for your long-term decisions. And remember, history is no guarantee of future results or that these patterns will hold.
Thanks, John, for helping us out with Investing 101.
My pleasure.
Go to businessfirstam.com for where to see our show on TV.